Welcome to Asian Investors Network, where we help our community prosper and achieve their financial goals. My name is Sam Fong, and I will be your host today. Let's begin. Welcome everyone to Asian Investors Network's first event in 2022. Our goal, as always, is to bring investors in the Asian community together to help each other succeed and prosper. So tonight, we will go around the room and have a roundtable discussion on 2022 goals, risks, and opportunities. We're currently projected to raise rates by 0.25% 3 times this year. So do these rising rates play a factor in your investing strategies this year at all? And if so, how are you adjusting? Anyone can go.
Well, I love it because because we haven't really had inflation in like a decade plus, or I mean, it's been many years, I think. One way that I'm taking advantage of it is, I'm buying the U.S. savings bond. It's called the I bond. I is in inside. It's currently paying like a 7% interest rate. I think that's like the best. I mean, you're not going to find that in a bank or anything like that. The only thing is it's only good for like 6 months. That rate is guaranteed, but yeah, I mean, that's one way I'm playing the inflation.
Hey, when you say it's guaranteed for 6 months, are you saying that rate is guaranteed for 6 months and it recalibrates?
Yes, that's right. Yeah, they recalibrate it based on I think they do it based on the consumer price index, which just came out today actually for December, and it was actually like 7%, 7 something percent. So I feel that the next 6 months it'll probably be at least 6 or 7%.
And the limit is only 10,000 per person, right?
That's right, per year.
Is anyone aware of any kind of methods to increase the amount?
I think if you got a big tax refund, you could buy some I bonds with part of it.
Do you know if there's a limit to that, to the refund?
I'm not sure on that one. I think it might be 5.
Got it.
Yeah, I just kind of wanted to chime in there. I think I posted something about the bond. So I've always had struggle with the bond situation because you want stability in the portfolio. But at the same time, it's like the inflation rates are just continuously going up. Now, if the inflation rate goes down at 2% in the next couple of years, then those bonds are going to be pretty good. The only issue is that if you take a look at the real rates on the bonds, you're actually going to end up losing money unless you can compensate unless you could sell it at a higher price. So I was actually tempted to actually get into buying one of those too, but then I thought about it, I'm like, wait a minute. The CPI number came out today at about a little bit under 7, I think 7% or so, a little bit under, or 7%, which has been the highest. And historically, they've actually done about 2% on the inflation, but it's really a tough call to make it for the bond market, just because if you think about it for a second, the stock market has been compounding for almost 15 to 20% on the S&P. If you did FANG, you're doing about 30% compounded. So it's actually a tough call to put bonds in. But I think with the Fed raising interest rates going into next year and then going on a more aggressive stand on this, some of the bonds could potentially be yielding a little bit more, assuming they control that inflation number. But you have to outperform stocks, which is, I think, a really tough call, because you look at the last 20, 30 years in the stock market, it's by far been the better asset class to be in. But again, I think stability is probably what people want, because you don't want those 30% drawdowns, especially if you're retiring. So I think there's a balance for the retirees and the people who are trying to get growth. So I don't know. I guess I think going back to the question was, how has that shifted your investing style? I think it's made it a little bit more difficult for stuff like that, just because they just keep on, I'm printing and printing and printing. So,
Right.
I agree with Ivan here. Just look at the dot plot from the Feds. Been looking at what 1%, a little more than that by end of 2022. It's not that high, despite the headlines you see on CNBC and other news outlets about rising interest rates. This really doesn't scare me that much. So I'm going to stay the course and keep buying growth stocks.
Yeah, and just to add upon that, if you take a look at the FANG stocks, the S&P 500, if you take a look at the earnings proportion relative to what actually was being built, majority of it, it's like 30% or so of the earnings came from the FANG. And the FANG names have been compounding on the revenue and the EPS numbers at about 20% per year. So it makes it very difficult to not want to put money in those companies like your Facebooks or Microsoft, things like that. Those are almost like blue chip bonds if you actually think about it, because they're not only are they earning, are they really stable? They're actually found in all index funds on top. And plus, in Apple's case, they offer a dividend of about 1% and change, which will beat the 10-year at some point. So you're actually looking at a company that is acting as like a bond proxy. They are the blue chip companies, and as opposed to buying a 10-year, you can technically buy Apple. Now, obviously, the volatility is going to be another issue, but if you average in, I think for me, it's always been the case of, can I beat Apple's moat, and am I able to achieve that type of growth on almost like a bond-like structure? So for me, it's like, I can still get 7% on Apple. If Apple appreciates by at least 7% per year, plus a dividend, it just has to appreciate by about 6%. You tack on the 1%, you're at 7%, and you pretty much beat any sort of bond. Plus, on top of that, you can also collateralize it and things like that. So anyway, sorry, I didn't want to dominate the screen here. Sorry about
that. This is Kong. I just so this is more like question and answer. So I've been pulling out a lot of cash out, and looking for real estate to buy. You guys have any like good recommendation where I can put my cash in, is pretty stable and still generate some number that just all I need is just beat inflation. So then the cash sitting there for like about 6 months or a year, waiting for to deploy it and still doesn't depreciate too much. Any suggestion or advice?
It depends on your risk tolerance, right? I mean, you can get very outsized return, but you're going to have to go out, on higher risk stuff, right? There's real estate out there that's, paying 15%, 20% cash on cash, but you just have to know the right people.
Oh, no. My question is, I'm going to buy by myself. I'm not going to put in syndication, but I'm trying to think of like what would be the best strategy for the cash where I can, where it's still like stable and still generate some number, so then the inflation doesn't really eat it away, So somebody mentioned bond that generates 7%. I'm not sure if I caught that.
You could house hack. You could buy a house and rent it to a bunch of university students on a per room basis. You'll get probably a 20% double-digit yield.
No. My question is, I have cash right now. I'm looking for deals, right? So and then it's hard to find deal, right? But if it's just sitting there for 1 month, I'm losing like 0.5%, right? So I'm
honestly,
trying to
if you're looking to invest that soon, just keep it in cash. I think it's probably not worth the risk of trying to put it somewhere else. Anywhere between like under I would say like 6 to 9 months, just keep it in cash. That's what I would do. I don't know if anyone has other bright ideas.
I mean,
because I went through the exact same thing, Kong, like about a year ago, saving up for a house and
I already have few. I'm just trying to scale it to industry, more like commercial side where I'm not very familiar with. So I don't want to buy more single family homes. So
you can check out some of the links I put in the comments. Lex Markets will give you overnight rates in stabilized real estate. Full disclosure, that's an investment portfolio company. You can earn 19.5 at Anchor if you're into kind of blockchain stuff.
So with this blockchain, like when you're earning this high interest rate, where's that money coming from?
That's a good question. I think it's coming from the inflation of the tokens itself. I'm not an expert there. That's just
Yeah.
the published rate.
So you're making 19%, but then like the value of your coin might actually go down, right?
Are you talking about yield farming?
Yeah, I'm talking about yield. Yeah, I don't understand yield farming. I don't understand where the
So-
money is coming from. Yeah.
So yield farming is like staking. Are you familiar with the term staking?
Yeah.
So there's like a lot of projects out there. For example, let's just use PancakeSwap. Is everybody familiar with PancakeSwap, Finance Coin?
Yeah.
I think it'd be helpful for the group to define it.
Okay. So PancakeSwap is a DEX where you can trade decentralized crypto. And then they have a token called Cake. And you can buy this token. Last year, it was, if you staked it, it was making 100% APY. So yes, the coin goes up and down. So you have to watch it and pull your money or leave it. Not financial advice, obviously you control your money. But there's a lot of other blockchains right now. For example, Phantom, where if you get into the liquidity pools, let me just post up one real quick that I hopped in. This one's called Dios Financing, and their APY, just check out the APY. Obviously do your own research, risk. Let me link it right here for everybody. So I threw in, for example, I threw in $100, and am I gonna make $1,000 at the end of the month? I don't know. That was my risk, but I saw the APY is at like 6 million%. That's how crazy some of these things are. If you do liquidity providing, where you lock up your funds and provide liquidity for some of these exchanges, you can make up to like 2,000% in 30 days. And then take your profits into your blue chips.
Where's the money coming from though? Like, why are they able to pay such high interest rates?
Because people are staking, and that's just how the projects are. So some of the developers will write some of these exchange, or will write I'm not a developer, so I don't understand the language, but it seems like they use the stake money to build their project, and then they pay back a dividend.
When they pay you back in the form of like
their
the
crypto.
coin, right? They don't pay you
Correct.
like the money, right? So I mean,
Right.
the risk is at the end of the month that thing's worth nothing because no one else is pulling their money into the liquidity pool, right?
Correct. I mean, this is DeFi. I mean, crypto is, it could pop 1,000. I mean, this is why you have to watch it, set your alerts. Like high risk. I wouldn't say this is something I wouldn't drop like 100 bands, and it's something like, all right, you got like a couple thousand and you want to try to 10x this, because that's, I mean, if we're playing with crypto, that's the idea. We're looking for the altcoins that are doing 1000x, and then when you take those profits, you're moving into blue chips, say like Bitcoin or Ethereum, and then that's what you're doing for holding. If another one is like Aave, for example, less risk. So for example, let's say you take 100 bands, put it in Aave, you can borrow that back in whatever crypto you choose, and then basically lend it back to yourself. So then you have like an interest rate of like 8%, and then you can take your 100 bands and then go and be your own bank and put that in an altcoin. Does that make any sense?
Sure. Yeah.
Okay.
And so basically the way it works, and I kind of posted it for anybody who's interested. So crypto is really on the more of the high yield stuff, because a lot of speculative stuff. But if you're looking for, I know somebody mentioned about real estate. I mean, it's not like that type of instrument. So definitely there's a lot more volatility in it. But I think
Are you talking about using crypto to buy real estate?
I think he wanted to invest money into like some sort of real estate to earn some sort of yield.
Okay,
on it.
so
Yeah.
let's talk about that. Sand token, Sand metaverse. Has anybody ever heard of that yet?
Mm-hmm.
Yeah.
Okay, so Forbes, for example, give me a moment. Let me try to find this article while I talk. There was, so we understand NFTs,
Yeah.
or do I have to explain NFT? Everybody understands NFT?
Well, I know, I understand it.
Okay.
Quick general explanation for terms will be.
So they're building a mansion on the metaverse, and then they're going to auction off a real one in real life. If you wanted to take crypto money and put it into real estate, you could either do like over the counter. There are companies out there that are putting it together. Let me just pull up the links. I just gotta dig them up real quick. All right, so the sellers, here's the link for the Sotheby's, so you guys can just get a clue of what I'm kind of talking about. There's that, and that's with the Sandbox metaverse. And then where is the, oh, here we go. And then this Red Swan article will tell you, is a PDF on how they're tokenizing commercial real estate. The big caveat for NFTs for us realtor guys is that you can sell off basically sell 1 million, like 1,000 NFTs, and then everybody can make money because it's a smart contract. Paula?
I have a question about buying real estate in the metaverse. Like, what's stopping somebody else from just making another metaverse and selling land on that metaverse?
Well, so it's all, so the metaverse is like a real life video game ish, and there's a lot of different metaverses. Obviously, outright Sandbox is like the big one. Snoop Dogg invested in it. He created a virtual mansion so he can throw virtual parties. He sold virtual tickets that are limited. And so now what's going on with those is those ticket prices are going up in value. They started, I think, like a couple hundred to 1,000, and now you can buy one for 4,500. The other thing that's cool about Sandbox is that they built a online NFT or online casino that you can invest in. You buy the NFT, and then what happens is the casino will pay all the NFT owners 50% of the profits. So that's another way you can create passive income with crypto.
So I'm guessing it's like, so let's say, for example, streamers. I know like YouTube and Twitch and Facebook are all in competition to contract streamers to stream on their platform.
Right.
Is that kind of like what the metaverse? So the metaverse would be like, hey, here's an incentive to buy land, and then they contract with famous celebrities.
No, metaverse would be like World of Warcraft, but in real life, if that makes any sense to you. Is that kind of a far out analogy? The reason why they're using influencers is just for marketing.
So okay, so there's like World of Warcraft, and then there's like League of Legends, and then there's like.
So the new one is Blocktopia.
Yeah, Albert. So I think your point is basically like there isn't one metaverse. So if you buy a house in a metaverse, it could, they could just build another house in a different metaverse. But it's just demand. So yeah, to answer your question, it doesn't. It's really
like a social media. It's the difference between Twitter, Facebook, whatever. So Blocktopia has their own metaverse. Sandbox has their own metaverse. Decentraland has their own Axis Infinity or something. I think there has their own metaverse.
I mean, Roblox, Minecraft, those are all metaverses. Look, there's more than one social media app. So obviously,
like MMO RPG would be like a metaverse that we as persons can interact online. For example, Blocktopia, you can buy your own virtual storefront. So Binance, all these other crypto companies are buying virtual office space, and you can buy virtual banners as well. will they be popular in the future? Who knows? And that's where the hype is. Sandbox is getting a lot of hype because it's getting, if you look at their metaverse, there's a lot of big companies that are invested in, like Atari. I mean, you can research it.
I think to sum it up, it seems like there is, so basically metaverses are like this kind of shiny new tool that developers are creating, like different universes where you can sell virtual land and monetize it in many different ways. But ultimately, it depends on which platform or which world is successful. Like say, will Sandbox be around in 10 years? If it is, and it's the dominant force, and virtual real estate catches on, then maybe that that virtual real estate is worth something. But if not, then you could see a corresponding decline in the value of any real estate you buy there.
I wonder with these metaverses, that can you buy like e-commerce goods, like real goods in the virtual world?
Yeah.
And do like AR, VR, and then that will be supported by edge computing, like a Cloudflare or a Fastly. It's like regardless of like which platform wins out, I see this gaining traction long term.
I mean, did anybody play Counter-Strike, CSGO, or any of that?
Yeah.
And then you get your skins, weapons, or whatever. So instead of buying them from Steam, now a content creator can make that and then put it on the metaverse, and then it'll be a unique item, and that will be for sale. I guess another analogy would be like sneakerheads. You know how like these leopard prints, Michael Jordans from 19 whatever, that are, I don't know, limited edition. And that's what they're trying to create, is you have limited edition on all these things that we can track. The cool thing about NFT is you can think of it as like being able to track all the barcodes in the whole entire world for every single item and track it. Almost like a notary system, if that makes any sense for everybody.
Yeah. Guys, at the risk of turning this whole discussion into metaverse discussions, let's go back to this idea of what assets do you think will be the best performers in 2022 and why?
Crypto. Because inflation. I mean, all these big companies are getting into it. I mean, he just posted that video of Michael Saylor. I mean, if you want my opinion, the best time to buy would be the beginning of fourth quarter.
Because of all the rate hikes?
No, if we look at like macro charts, because with stocks and everything, it kind of all correlates and follows. If you guys are into looking at charts and patterns and all that junk.
I think it's going to be a tough year for a lot of risk on assets, though. We've come across the last 3 years, we've been pumping pretty hard on many of these risk on assets. So I think it's gonna. I feel that maybe this year may not be the best year for some of the risk on assets like crypto and some of the tech growth stocks. But I think maybe if you take a look at a 5-10 year period, then I think the question it really should be asked is more about what's your time horizon. So we came off from the pandemic with almost 3 years or 2.5 years of pure growth in the tech sector, which is a risk on, and then also in crypto, which had you invested in crypto in March of 2020 when Bitcoin was at 3,000, you would have far outperformed every asset class by far. So crypto specifically has been the best outperformer, and not just in this last 2 years, but also in the last 10 years, outperforming real estate, gold, equities. And then the coming in second is obviously your tech, and then your commodities and oil, things like that come in a little bit later. Real estate has actually done really well. But if you take a look at the next, let's say 2-3 years with the rate hikes, it's almost kind of like, I think there's going to be a pause in some of that, but I think overall disruptive tech is still going to be fairly good. Equities, I think, are still going to be good, even though people are expecting a major recession and also a bear market, but which is kind of interesting because we just came off of a pretty bad recession. So any hard asset, I think it's going to be doing really well. Specifically, residential real estate, even though people are expecting a crash there too. So, but I don't know anybody here has any experience with residential or commercial real estate, but I think people kind of mentioned that earlier. But it feels like there isn't enough supply for a lot of the as far as the population that's coming up. You know, everybody wants to buy a house, everybody wants now a larger property, but yet there's just not enough. First off, good land and development is actually at its slowest rate in the last like 10, 15 years. So I don't know, my bet's going to be on like real estate. And then on the opposite end, it would be pretty much like this, a lot of this disruptive tech that I think it's going to upend a lot of the stuff that's happening that happened prior to the pandemic.
I agree. I think those are very insightful comments. Speaking from the private equity side on an institutional level, commercial real estate has been kind of mixed bag depending on what type of asset, right? Like I think Joseph mentioned retail and hospitality has been struggling, but multifamily and industrial have been doing extremely well. And, you know, a lot of those assets barely took a hit and also performed really well, especially if you had been investing in 2020. Issue now is there's a lot of competition. Everyone and their mothers are chasing yield. So there's very high competition in all the major markets and even in the secondary and tertiary markets. So it's going to be interesting. There's low inventory in residential too. And so the developers are trying to build madly, but now you have institutional buyers that are competing. Not just mentioning Zillow and the other programs, there's also like private equity funds with, you know, billions of dollars of capital trying to snap up residential either for rental or to sell as a portfolio. So I think that, you know, there's a lot of nuance, right? Like there's demand because everyone is trying to buy a house still, but there's also there isn't enough supply. So it's interesting.
The only one I can't get my handle on is gold. Gold's underperformance, despite the massive money printing. I remember buying gold back in 2011, 2010 when it, you know, spiked. And then I was told that, you know, after all this QE and all this money printing, that it was going to inflate. And what had happened was I still have my silver coins. I bought a bunch of that and I bought some gold bars. And it hasn't done anything. In fact, it's almost a little bit above from the 2011 peak. And I think it's kind of interesting to see that sometimes the narrative doesn't really work out in the real world. But housing was actually the correct play to do back in 2011. So, but people were saying, oh my God, we're going to crash again, you know, and there was a lot of people on the sidelines for real estate because they were expecting it to crash again, because they're inflating. And so now I look back at my decision to buy gold and I say I should have just bought another house, you know? So I don't know.
All the money that would have went into gold went into crypto. If you look at the market cap rise, so it's like something like 2 trillion. So that's why.
Yeah, actually, I got off a call a couple of days ago. Some guy called me, he started selling me gold. And I said, who's buying gold? He's like some guy, basically people over like 50 years old. And I say, any young guys buying gold? And he's like, no. I was like, oh, that business is dead then.
No,
and so
Ivan.
Yeah,
I've seen people get in tungsten.
I have a question.
Yeah.
I said the same thing about Rolex. I was saying the same thing about Rolexes and like luxury watches. Anything that's like a smartwatch is going to be dead in the next generation just because they don't provide as much value. If it's not like doesn't have a screen on the watch pretty much.
So like a Rolex, you say it's not a good place to park your money. Because I see a lot of crypto guys buying, a lot of people buying Rolexes.
Yeah, that's rookie stuff. You want a Patek. You want a Patek.
So you basically invest in the like an Apple Watch or something?
No, I mean if you're getting into watches or any of those things, you want to find like the most rare like Patek on the planet.
Oh,
I
got
think
it,
there
got it.
was one, I forget which model it was, but it's a very plain one. I think it went for like 95 and now it's worth like over 100.
Okay.
Same thing with cars. Like if you want to get into like not just like any fancy car, but like the GT cars, like like a Ferrari Pista or like a GT3 RS with a Y-side package, stuff like that. That's really rare.
So okay, got it. Well, there you go. I can park some of my money in there instead of.
I mean,
I think
it's almost you have to have connections, but the idea would be like you find somebody overseas who can't get it over. Like for example, the Pagani dealers in Newport, and there's only 5 Paganis being built this year, and they're all like $3 million. But when that person takes delivery of that car, it's gonna be worth twice that much. But some guy in Dubai is gonna be like, I want this car, ship it to me.
There we go.
Yeah.
That's the secret.
it's a huge conversation, but basically, all the governments they have no choice but to continue printing money. So the assumption is that there's going to be a lot of fiat currency sloshing around. So it's imputed that any asset that's a store of value, not just any watch, but like someone said earlier on, the rare collector's item and all that, because we need to have something to store the value of all the cash that's going to be coming down the pike. It's just a given. So real estate for many other reasons, but just on store of value, real estate, gold is not really what it was. I mean, it's such a political metal now. It's not a precious metal anymore. It's a political metal. We have all the central banks owning like 60-70% of all the gold that's available. There's a lot of manipulation. And we just talked about all these young guys, they're just like, gold, what are you talking about? Because of cryptocurrency. So it's a double whammy there. So Peter Schiff is a great gold bug to listen to, in spite of the fact that gold has gone down like 4% and everything else has gone up. Cryptocurrency has gone up, Bitcoin has gone up. He continues to deny that, but he's really, really smart. I mean, you have to learn things from him. Peter Schiff is just incredible. Sometimes I think it's a strategy that's doing it because his son is in Bitcoin, but he's not. So it could be a tag team thing, but whatever it is, Peter Schiff really is a smart person in terms of equities and all that, but he's a gold bug. And he's like, it will happen because it's a store of value. Anyway, so that's that. So back to the property narrative. We know that since the pandemic happened, a lot of off-site working, Zooming and all that, and then I don't know if you guys talked about this before, but permanently it's changed. Permanently, even if it's a 30% return to offices, you're still going to have a lot more people wanting bigger houses and all that. So stocks like home improvement and families and family homes and all that, I think it would just, if they don't keep the value, it will increase. And plus the fact that I said early on, because of the money that's printed, there's so much cash coming down the pike. I think housing is a store of value too. And in spite of, and also there's a cash flow coming in because of the rents that we will be collecting. So very quickly, my game is I have very long-term cryptocurrencies. Well, when I say crypto, there are really 2 classes, Bitcoin and everything else. So it's very, whether you talk about your NFTs and all that, it is a very high risk, high reward, but more than that, high attention. It really requires high attention. So I just want to have my life, live a life. So I don't even do NFTs and staking and all that. It's just a lot of hand holding. If I don't keep up with it, I'm gonna burn my pants. So anyways, so I have Bitcoins. Then I actually take loans off Bitcoin, loan to value 50%, 35%, whatever it is. So with that money, I actually take a hard loan also, and I buy real estate, a rental property. I fix them up and rent them, and then usually I get between 12 to 18% return a year. Without my annual returns, it's 12 to 18%. Plus the fact that I still have my cryptos because I didn't sell them. I have my Bitcoin. There's no capital gain since I took loans on them. And it's the worst that has happened was last year. It's a return of 60%, 60. And the previous 11, 12 years has returned 160%. So that's That's my game. 90% of my investment is actually on this passive thing that's sitting around. 10% I'm playing with it. A lot of fun, a lot of excitement and all that. But so that's my game. So I'm here to listen to what you guys are talking about. Those bonds that are returning 16% and all that. It doesn't excite me because of what I just said. The accumulated interest, the return on my accumulated investments, it's safe and it's pretty darn fun too, and it's high. So that's my game.
So when do they what happens if they do margin call on your Bitcoin? Like say it drops further from the 40,000, how at risk are you of, I guess, losing your original Bitcoin?
No, my original is 300.
All right, never mind.
Kong was an early adopter, very early adopter.
2010.
Oh my goodness.
But even if you take any 4 or 5 years, if you buy a Bitcoin and hold it any 4 or 5 years, it's a positive. Anytime you buy and keep it over 4 years. But I just need to be fair to my fellow Asians here. There is Bitcoin and everything else, and the narrative for Bitcoin is very different. The narrative for everything else is very different. Everything else, Ethereum and you name it and all that, it's just like Apple Computer or Microsoft, whatever. They're all startup businesses. They have it's a project. It's a project, and basically they're solving an issue. There's a problem that they're trying to solve, and if they're successful, and many of them will be successful, so it should be looked upon that way. And Bitcoin is not. Bitcoin is trying to be sound money, and the way the governments in the world are printing money and all that, that's where Bitcoin is heading. All the other coins are basically startup businesses trying to be incredible financial tools. So that's a narrative. I have altcoins also, but I just go ahead.
I think that was a random noise.
Oh, okay.
But yeah.
So I do have altcoins also, because it's like buying Apple Computer or Amazon and all that. There are certain coins that are very promising because they've got strong leadership, very strong case and use case and all that. So I bet on them, and the returns are pretty good. I mean, Ethereum has gone up by, it used to be 200, and then now it's like $4,000 now, but 3,005. That's incredible. So it's got a good use case, just like any business that we would buy, Apple and all that, or Tesla. Tesla is another incredible one. But they are a startup business. So I just want to be, I just care too much that people get so confused. NFT is incredible, but it's like, which one, So my God. Anyways, I will keep silent now.
So it sounds like for what people believe that which assets will perform well going forward, given this environment, is hard assets that are a store of value. And it sounds like people are generally pretty optimistic or have high conviction on real estate and crypto, and to some extent high performing companies, tech companies. Does anyone want to add anything to that, or should we move on to the next subject?
I have a question. This is for the gold bugs and the silver bugs out there, especially Ivan, you have some. I want to ask you, how do you dispose the physical like silver and gold?
Yeah,
without getting a hit.
Like dispose of it, like as in sell it for a profit, or
selling is the main thing. Like buy gold, silver anytime, store it, but then you're gonna get killed when you sell it.
Yeah, so I'm gonna tell you guys from my experience, and this was like, I thought I was gonna make it big. I was gonna become a millionaire with this stuff. Because what had happened was someone said buy silver, right? So silver was really cheap back in like 2008 or whatever, 2009, 10, 11. And so I wanted to get rid of it because it had appreciated really quickly. So the only place is literally, I'm here in LA, and I try to find a way to unload it. And it was very difficult because there was one place called like a pawn shop, but the pawn shops would actually give me a lower price than spot because obviously, they need to make money. So then I went to these coin dealers, and the coin dealers, literally, they kind of like fleece you, because what had happened was the bid to ask spread on these coins, it was actually bullion coins. So it wasn't too bad, but they were actually almost like 20% spread. So basically they were making about 10 or 15% just right off of the spread from the buy and the ask. And I thought it was kind of ridiculous. And they said, well, I got to keep the lights on. So the problem with physical gold is that they have to pay overhead whenever they're holding it, and they'll put that into the spread. So there's no liquid market. You can buy it. If you buy it, you can buy it at almost spot. But when you sell it, they need to sell it back. So usually there's only two options. If you want a quick, you can go to a pawn shop, or two, you can go to those coin dealers, which they're not a lot anymore. Or three, you can go online and ship it to like on eBay. And I was able to sell some stuff on eBay. But then that got a little risky because some people were saying, oh, you know, I never received it. And then all of a sudden I got screwed over because eBay automatically says the buyer never got the product. And so I have to pay for it. So I was trying to get rid of this stuff. And I found out that physical metal is just so much more difficult. So I just went ahead and bought the ETF for gold, which is GLD. And that is almost kind of like it tracks the spot price. And so, you know, that's probably your best way. But the other issue I came up with is that gold is a collectible. So when you pay taxes on it, you're going to pay a collectible tax, which is higher than capital gains. So I said, why is gold considered to be a collectible? They're like, well, it's collectible. I'm like, yeah, but I'm not using it as a collectible. They're like, yeah, but the tax rate is much higher. It's almost kind of like selling an art painting. So I said, you know what? Let me just stick with stocks. Bought the ETF, but then you got to pay on the GLD shares, iShares, you got to pay a fee on that, which is like about 2% annually or something crazy. So anyway, long story short is that buying gold is not a problem. People will sell you that stuff easy. The problem is the liquidity. There is no liquidity for it. It's not like I can go to my friend who wants to sell. In fact, you go to any everyday person, they're not going to want to buy it. So you have to go to these very special art show, gold shows, conferences where you can go to like major areas. If you live in a rural area, you have to drive out pretty far. So I still have my stack of gold here just in case like the world hits the fan. But I made the comment that someone made a comment is like, if gold ever goes to like $10,000-$20,000, that's a world you don't want to be in, because at that point, basically it's like guns and butter. You know, pretty much, because everything has collapsed. And so I don't think I won't be sitting with my gold bars, and there's no liquidity there, and you can't go to a bank to sell it. They don't want it. So anyway, long story short, I just want to share that experience with you because
no, that's very good experience. That's actually exactly what like I'm scratching my head, you know, about that.
Yeah, it was a nightmare, and I thought I was going to be rich. I thought I was like, oh my god, you know, I want to be rich with this. I'm gonna buy a Lambo, and you know, and gold's gonna go to like $10,000 or something, and literally it was like the biggest disappointment I had in
you know, in this
I
in this
remember.
day and you know, in this day and age, if you want to buy gold, maybe another parallel play would be buying gold miners, because gold miners,
right,
you know, it's not taxed like a collector's item, and you have a dividend coming in too,
right,
and so that's the gold play. The other thing about, if you want to buy gold as a store of value, you know, as an asset of store, you know, store of value, if it ever goes into 20,000, that means like the world has come to an end kind of thing, you know. But the problem with gold is, like I just said, you can't carry 60 pounds of gold across the border, you know, and you got to pay for security, you got to ship it, you know, it's a lot of very, very difficult. So maybe even a year ago, I would still say this, but a year ago it was still kind of iffy. We're talking about Bitcoin actually. A year ago, we're still wondering like, oh, Bitcoin, you know, hey, that pyramid scheme and all kinds of stuff. But this day and age, you know, Bitcoin it's given. It's not going anywhere. It's not going to be outlawed. Well, maybe in China, but it's here to stay as a store of value. There's so much commercial and industrial involvement in that. The government is involved in that and all that. It's something to stay. So in terms of a store of value, in terms of if you want to store your value in gold, you might as well store it in Bitcoin, because Bitcoin doesn't have a security issue. It doesn't have a authentication issue. I mean, how do I know your gold bar is 100% gold? Maybe you put stuff over it and all that. And I got to test it. I got to go protect it. I got to ship it. I mean, it's a lot of, it costs, you know, many percentage points to even hold it, let alone send it and all that. But for the For the Bitcoin, which is, like I said, in this day and age, it's not going anywhere. It's staying. It's a real legit asset class. So, you know, a flash drive or a paper wallet that you remember 16 words, you know, and that's your coin. And when I sell a Bitcoin is a Bitcoin is a Bitcoin. There is no authentication problem because it is pure. If it is not pure, it won't go through to you. So security, transportation, hiding it, selling it, there is a huge a market that can tolerate $1 billion of transaction anytime. So if you guys are thinking about gold, you might still think about this because today gold, I mean, Bitcoin is not a iffy thing anymore. You know, it is here to stay. So that's my 2 cents that I tried, you know, that I try to help propagate, that if anybody's considering it, you know, 6 months, a year ago, you're still wondering whether Bitcoin will be, you know, will disappear. It's not gonna disappear anymore. I mean, for you guys who are busy, you don't know what's happening, so you're still wondering. But in terms of, someone just posted about gas fees. No, Bitcoin's gas fees is like, you know, $8, $13, you know, $20. You can send $1 million, you can send $10,000. You can send it like 8 a.m. in the morning, whatever time you want with your phone. I can send my brother money and he'll get it in 20 minutes. Gas fee is not Ethereum. So anyways, for you guys who are not aware of it, there's so much happening right now with the government legislation and all that. Bitcoin is not considered crypto because crypto is basically a security because they're all issued, they're not, except Ethereum. Most of the other cryptocurrencies are a security. Therefore, there will be some issues. Not that it will disappear, but it's a security. Ethereum, but more so Bitcoin is an asset. It's like a home. So the capital gains and all that, you know, it's a different case. So there's too much to talk about. But the last thing I want to talk about is if a security has got so much risk because you've got operational risk, you've got legislation risk, you've got taxation risk, you've got you know, it's a functioning business. So there are all these risks. But an asset like a house or even Bitcoin like a house, the risk is a hard asset. So there's no risk of success or not because it's not an ongoing business. So it's really fascinating, but most people don't have the kind of time to keep at that, you know. So I'll just leave it at that. If you want to go buy gold, you might want to think about Bitcoin because it's definitely here to stay, and the cost of transaction, the cost of storage, the cost of selling is really low and easy. That's my 2 cents.
Thank you for sharing. All right, so let's talk about any sort of specific risks that we should look out for, and any sort of market developments that we should be considering in the upcoming year or so. So we know that the Fed's planning to raise interest rates, right? What would that do to the stock market in general? What do you think that would do to real estate? What do you think that would do to crypto and other ones?
Yeah, so I mean, the first thing is you got to look at the stock market's tied up to the recession, to earnings, right? So if earnings go down, usually the stocks go down. Now, the reason why we went up these last 2 years is because we had a PE, we had a lot of money getting injected into the stock market. So what had happened was the earnings numbers were actually either stagnant in 2020 because of the shutdowns, but because they injected a lot of money in, they elevated a lot of those stocks up. Now that the economy is opening up, and everybody's kind of going back to work, those earnings multiples should continue to go up. Now, one thing I always look for is the inverted yield. So every time we've had an inverted yield, which means the 10-year and the 3-month, or if you want to take a look at the 10-year, you know, and anything lower than a month, has always predicted a recession since the 1970s and 60s and whatnot, going all the way back.
Agreed.
Right now, a lot of people are thinking that we're going to have a massive recession. But what they don't understand is the bond market is not predicting that. The bond market is actually predicting it's predicting a stagnant growth, but we're not actually inverted yet. So not to say that we may not hit a recession, but it will be a double dip recession because 2020 was technically a recession. That's when you have contracted GDP numbers coming out. And so what's happening right now is people are confusing inflation with a slowdown in economy, but in fact, people have more money in their pockets. So, but the risk here is the actual problem that we're not going to have, people are not going to be able to spend that money because of the shortages. So the big risk here is a supply chain issue. After the pandemic hit, the risk of investing has been in supply. Basically, all our supply chain is all integrated together. So one country shuts down, the other one opens. We have a huge bottleneck. And if you guys already know, like housing is a great example, lumber prices have skyrocketed just because we've had issues with getting some of that lumber over to housing, and a lot of the housing prices have gone up because of that. So in a way, the real risk here is not necessarily like what the Fed is doing, is what necessarily how they can fix this supply chain bottleneck that's happening. And part of that has to do with the money that was put into people's pockets when they were shut down. They wanted to buy goods like a refrigerator, they wanted to buy a car, but then the problem was the factories were shut. You know, they had shut down Tesla, as an example, in the Fremont plant in 2020. Elon Musk had to sue California to get that plant back on, but they were backed up in terms of those cars throughout 2020. And all of a sudden you have a demand for the vehicles. So what do? They started to raise those prices. Same thing happened with Toyota. Same thing happened with some of the other vehicles. They didn't have the chips because they had shut down those manufacturing chips in China and in Taiwan. So I think the biggest risk here is a possible recession caused by a continuation of the COVID pandemic. That's most likely going to continue because there's so many variants now, and every country has their own protocols. One country shuts down, the other one opens. And I think the bigger risk is not so much about propping the financial assets, but making sure those earnings numbers come in so the economy jumpstarts back up. The other issue is going to be the fact that people are going to be out of a job, right? So companies have laid off a lot of people because they are flush with cash. They don't need as many bodies anymore as they used to because now they're using disruptive technology. Like, for example, I take a look at DocuSign as a great company, right? People used to have, companies used to have people just to sign documents, notarize them and all that. Now you eliminated all of that. You have companies like DocuSign that basically you can just sign at the comfort of your own home. Companies that have commercial real estate, for example, like this meeting that we're having, we used to have a conference for those. Now we can pop in Zoom and you automatically eliminate hotel bookings, and you also eliminate a lot of the middleman that's required to book, people getting together. And so you're starting to see a lot of jobs that will never come back. And I think that's probably going to be the bigger risk because those economies that are kind of built on that are probably not going to recover. And you're going to have a potential situation where you have people who are going to do really well and the people who are not because of all these disruptions that we're having. So I think the tail end risk is going to be how this new economy is going to look for the next 5 years out. That's funny.
I think that's a great point. I believe that there will be persistent supply chain issues, as you mentioned, because of the ongoing pandemic and their different responses to it. It does seem likely that since there are so many variants, many of which can get past the vaccine, we're going to continually see disruptions. So like, used cars, for example, went up in price by quite a bit because no one could get new cars. So I think that there's really a lot to think about, but what do you think, what does everyone think is a good move in this coming year? Like, are you deploying your capital more? Are you being a lot more risk averse? Are you looking more for value in the stock market, or are you still going for the growth companies?
I think holding cash is a huge mistake. Holding cash because of how the QE, even though they're tapering and all that, there's still going to be a lot of cash that's and coming down. And I think that whole threat of raising rates like 4 times and all that, more than anything, I think it's that the message is in the message. They don't really have to do anything to try to elicit some kind of action. I'm not really sure that that's going to happen when they actually raise the rates. In any case, 1-2% interest rate raising is not like when Paul Volcker was around, raised it to 20%, it came inflation. So So I think it's really problematic. And because now our GDP and our debt level is so really high, they can't raise it substantially over 2, 3, 4, 5% because the interest payments would just kill the country and the companies, the US companies. So it's really strange. But keeping cash is definitely, I think, in my view, a real mistake. Bonds is also a mistake because it's basically cash. Getting 5%, 6%, I think it's an issue. It's a problem because of the devaluation that's occurring, which is in some quarters, Michael Saylor and all these people, they think it's more like 15%. The CPI of today, if we use the same measurement that we used in the 80s, it's more like 15%, 17%. But they moved the goalposts. The CPI measurement today is very different from the CPI's basket of goods, 10, 15 years ago. So, and the other thing about it is that there is inflation rate and there is the inflation rise. The fact that inflation hasn't gone up doesn't mean the price has gone down unless we have the deflation. So therefore, when we talk about inflation is zero, but it's already gone up last month or last year. So that's going to be a lasting, so the difference between the rise and the rate, that's going to be a lasting impression on the citizenry. So money printing, it's not going to be stopped. In the 07, 08, we printed in about 3 years, 300 years worth of money printing that this country did. In the last round of printing, in a few months, we printed the same amount in a few months. It's just exponential. This whole solution to our monetary policy is just exponentially because gonna skew up because they're applying the same solution. Not that I can do any better, but I can just see that this is an issue. They will continue printing because there's no choice. You can't pay the interest with taxation and all that. So having said all that, just don't keep cash, don't buy bonds. I think equities basically will be ahead. It usually will be ahead of inflation. Hard assets like our friend said, gold, Bitcoin, and housing because of the shift in working ethics and home offices and all that. Just don't keep cash. That's my take.
Yeah, there's definitely a danger in how inflation's going and how that will erode the value of your money. It does sound like some people will be keeping some part of their portfolios in cash to seize opportunistic investments, which I think is a good idea too. There could be some, outstanding opportunities as the market reacts, and inevitably there are some inefficiencies that you can seize on. But I guess to wrap it up, what do you think are your goals this coming year then, investing wise? Open question.
Be my own bank.
Be your own bank.
I think mine is going to be financial freedom and trying to get my time back, because I know COVID has changed my perspective about life. I mean, the fact that it could end tomorrow with these variants. I think buying my time back, because every single time I always look at my career trajectory. I always look at, okay, I'm going to save right now and then spend it when I'm retired. But the problem with that is that when I'm older, it's like I don't have the energy and all that. So my goal is to get off of the 9 to 5 or whatever grind I'm doing as quickly as possible, so that I could technically live a free life. I think at the end of not necessarily buy cars and Rolexes and nice toys, but it's more about my time back. I think, and everything for me is structured around that. It's just getting that time back that I'm wasting trying to grind out fiat or whatever it is to get any sort of toy. But I definitely feel that being in the right asset class is more important, because the W-2s that everybody gets, I mean, that just kind of keeps you afloat, but it never makes you like super wealthy, and it doesn't give you freedom. I mean, you literally, money can run out, really quickly because they just kind of turn off that valve. But even then, you're fighting inflation, which has been problematic for the last, 40, 50 years. So my thing is migrating over the fiat quickly to assets that produce cash so that I don't have to trade in my time for money. So I think that's kind of like everything revolves around that concept versus trying to find the next hot thing that's gonna 10x or something like that. Yeah.
Sure. Thanks for sharing that perspective.
Hey, the other one thing that I do, Sam, is I actually really believe that money is getting smaller. The value of it is getting smaller. So I actually take a lot of loans.
Yeah.
That's one of the big things. I'm taking as much as I can.
Yeah.
I don't care if it is. I really don't care if it's 8% or 9%. I've got private lenders that lend me because my cash flow can handle it, and it's a tax deduction. It's totally an expensable item. I mean, who cares? And when the property appreciates by 3 to 5% of the principal amount, not on my deposit, and plus the rents and all that, that's all to me, and my expenses are all expense. It's incredible.
I'm gonna kind of add to that point because a lot of people think that you should pay off everything, you should be debt free, but the reality is that if you take money right now to pay off debt, the money, you're actually shooting yourself in the foot, because 20 years from now you can actually pay off that debt with cheaper money. And that's why people say, I want to buy a house in cash. I always tell them that's a mistake, because 30 years from now that house would appreciate a lot more, and you're earning money that you're actually making a lot more money. So people say, I don't want to have any credit card debt, no loan debt, no nothing. Obviously, you don't want to be in a situation where cash flow is a problem, but you also don't want to be using your present day cash to pay for debt that technically can be paid off with cheaper money in the future. And I think that was the big misconception that a lot of the young people said, if you're paying 18% on a credit card, it's a whole different story. But you could always refinance. And what I also found out was banks actually like it when you take on debt, because they actually like to make money with you. And so if people don't have any debt, they don't have any history, they can't trust that you're going to be able to pay. But if you have a lot of debt, it's kind of weird. The more money you pull out and the more current you are and the more assets you gain, the more money comes to you. So I kind of find it very counterintuitive when people say, well, you have so much debt. I'm like, yeah, because I make that money work. So I don't know. I think it was kind of touching upon that point, that there's this misconception that debt is bad.
I think it's mainly the Dave Ramsey disciples who believe
right.
But I don't know that many people who want to pay off like their mortgage or like be debt free. Maybe the older generation too, because they grew up in a different time.
Yeah, that generation, like my grandma was always like cold hard cash, always have in your wallet, and don't use credit cards. And I was like, well, why wouldn't you? It's very convenient. I mean, do you really want to carry like $5,000 in your wallet? And I see some very older Asian women who carry in their purses up to like 5,000 when we go to a grocery store. And one time one of them got robbed. And I asked them, I asked them, why do you carry so much? Because they say they don't trust the banks. They literally think that the bank's going to run away with their money. And so they rather keep it in their purse or underneath their mattress. Because they believe that if they put that into, let's say, Bank of America or something, that the banks that go bankrupt and all their money is going to be, all their hard savings is going to be gone. So I don't know if that's a generational thing. It could be a generational thing coming from like Asia, where there's a lot of bank failures.
I don't trust banks. No, I don't trust banks after 2008. As a realtor, I literally watched them steal money. No, literally watched them steal money from clients that were trying to do a short sale and disqualified them. I watched that firsthand.
That's true.
You know what I mean? So no, I do not trust banks, especially Chase.
Chase. I talking about Chase or Bank of Chase?
No, I'm talking about Chase Bank, Wells Fargo, Bank of America.
Wells Fargo.
Scrupulous punks. You know what I mean? Crypto. Be your own bank, bros.
Yeah, well, technically, those are not banks. They actually call them money centers now. The Wells Fargo, Chase, and those guys. They actually, if you go in there, they're technically money centers. But yeah, I mean, I think
cool. That's what they are.
But I think the point was, because I was having this conversation with this older lady, and she mentioned that she likes to see the physical like paper. Like she actually likes to see hand. Like she doesn't like this idea of like digital thing. Like it just doesn't exist. And so she actually wants to see like the picture of Ben Franklin like on a bill and actually hand it to somebody. So I don't know.
Yeah, that's a flex.
How about Kenny? I know that you've been investing in stocks for a while, and you're a disciple of Warren Buffett's teachings and principles. What do you think?
Oh, yeah. Well, I guess is like as far as like my goal for this year, 2022, I guess is I just want to try to just try to make like try to keep my I guess my yield up, like my just yeah, just try to
Do you think
make like a value investment, I guess, like
so? You're still going for the more value stocks as opposed to like growth companies, right?
yeah.
Got it. Awesome. Any other perspectives?
Yeah. So like I said, I actually pretty much only own Tesla and Ethereum. But last year I kind
Is
of
that 100% of your portfolio, Tesla and Ethereum?
Yeah, 100%. Yeah.
Wow. Super high conviction.
Yeah. So this past year, I learned a pretty good way to make residual income. So what I've been doing is I've been leveraging my Tesla shares to sell puts. And I just started learning like 6 months ago, but I've been making like 5 to 10K a month. So this year I'm trying to make like 150K just selling puts. And I think if you believe in the long-term trajectory of Tesla, I think it's a very easy investment to make. So what I'm doing is I'm using leverage, but what you can do, so what I think you can do, if you're trying to make like 30%, 50% of your money, I think it's super reasonable to do cash secure puts on Tesla. And what that means is you basically agree to buy these shares at a certain price. So what you would do, let's say for example, the price today is $1,000. I would say, okay, I'm willing to buy 100 shares of Tesla at $1,000 next month, right? And the premium for that is like $8,000. So you wait a month, you make $8,000. And then if the price is above 1,000, then nothing happens. You just do it again. If it's below, then you just wait until it gets back to $1,000. So even if, let's say, for example, out of the year, you're waiting 6 months, which I don't think will happen, then you're gonna make 6 times $8,000 or whatever that is. So it's an easy 50% of your money, I think. I mean, if you want to kind of scale it back, 30% of your money. So I think that's a very easy way to, at least in my mind, if you believe in the long-term trajectory of the company, to make money. So my goal, yeah.
Where do you think the risk is in that strategy?
So the risk in that strategy is if, let's say, for example, I sell a put, the price goes down, right? And then just stays there. It never goes back up. So I bought something for $1,000, but it's only worth $800 right now and just stays there forever. Then you lost $200 times, 100. But if you're using cash to secure the puts, then it doesn't really matter. You just, if you believe long-term, you can just hold it, right? If you're doing margin, then yeah, then you're probably in more trouble, but you can always roll, roll it. But yeah, I mean, like, I feel like it's a very, I don't know, I can't really think of a reason why it's not a good investment. That's what I'm doing. Yeah.
Yeah, I do that too. I enjoy selling. I like to sell the put contracts. Because I mean, I try to find companies where, like, if I have to buy that stock at that strike price, I don't mind holding it for years. I'm actually doing that with I started doing it this year with the company that makes Bowflex, or it's
machine.
Yeah, the exercise machine. They yeah, like I've seen some
Is that Precor or a different one?
Sorry?
Precor, like Peloton Precor, is it? Or
well, no, I think like their brands are like Bowflex, Nautilus, and I forgot the other one.
They were on TV. They did the TV stuff.
Yeah, you always see them on TV.
Like after hours.
Yeah, exactly.
The Nautilus was like the ski thing, and the Bowflex was this was like a
like
these
ellipticals and
like this band bar thing. It was kind of cool.
How are the premiums on that though?
Yeah, I mean, you see, I've been kind of interested in doing like because they have like a 1 year that expires in next year, like January 2023. The price of it is like 5.84 or so. I was thinking about selling like selling like the $5 strike price. It's roughly about like 22 or 25%. So like, I mean, it's like $1.
Oh,
We'll say $1.25
Yeah.
for for each contract.
or a year out though. It's like 20% for a year out, right?
Yeah.
Yeah, like that's why for Tesla is like you can make 8% for like a month out, right? So it's just because
Yeah.
there's so many people that don't understand it. I think is that so there's a lot of like volatility. So that's why it's really good to do it for Tesla because you get your premiums are super high.
Yeah. Right.
Hey, Albert.
Still like a month out, right?
Yeah.
Hey, Albert, just to clarify, since you're selling cash securities, you're not really leveraging your Tesla stock, right? You're just leveraging your capital to earn premium.
Well, the example I was giving is doing cash secure, but I'm actually leveraging my Tesla stock. So I don't really hold that much. I hold some cash just in case I get margin, but like the rest of it, I'm just using my Tesla stocks to sell the puts.
Got it.
Yeah. So what I was explaining is something that I'm not actually doing. Like what I was explaining is a little bit safer. Yeah.
Do you ever sell calls for your Tesla actual stock?
No, I don't sell calls because I don't want to miss the run up, right? Yeah. It just runs up for no reason, so I don't sell calls. I only sell
Yeah.
Fair enough.
Anyone have a bet against Tesla?
No, not a good idea.
That's tough. That's a tough. It's tough. That's a tough position. Yeah.
I mean, I drive a Tesla, and I'm firsthand experience to the quality, how sophisticated the software is. I mean, right today they can actually do your semis. You can do city to city, autonomously. That the software is good enough to do that. So just imagine when the semis come out. I think it's more than. We all know that it's way more than a car company. The tech is so way in advance and is vertically integrated. I mean, they're not harmed by the semiconductor shortage. The sales has actually gone way up too. I mean, I think BMW also did that too. So years ago, people were laughing at Elon because he was vertically integrating his. He wants to do everything himself except the car seats. And people are laughing, but it's proven, it's proven it works. Apple is basically vertically integrated too, by selling all these calls and all that, it's only because we know the company is really, really solid. So, that old adage, which is, buy what you really know. And I think it's really, really true in this case for Tesla. If you bet against it, you lose your pants, I think.
Yeah.
Yeah. Without getting really preachy, I just want, if I take 10 seconds to kind of explain why I think Tesla's going to do really well. So just a few things to note is like the cost of how they produce is very efficient. And then so like they rode the cost curve down on the like laptop batteries. So their battery cost is very low compared to all other manufacturers. So their margins are super high. They're like 30% gross margin right now. And then as far as competition goes, like I don't think people understand like how behind your legacy car companies are. So there isn't really any competition.
Absolutely.
Right? And their scale is gonna be really large. So they're gonna be scaling up like I mean they say like 50% growth the next 7-8 years. So I think that's why I think it's very safe. But yeah, you can go into I can talk about it all day, but there's a lot of points that I think are like it's very clear that they're gonna win the EV business, the full self-driving, right? Yeah, etc.
What do you guys think about?
Don't forget why they're fighting the dealership model. That's like a dinosaur thing. The cost of maintaining dealership. In fact, the bad service that you get from dealership and your brand name and all that watering down and all that. Tesla has no dealership, so I think it's a far superior. No bargaining. One price. I mean, that's the way to go. I really think it's superior, in my opinion.
John, you had a question.
Yeah, I was just gonna see what everybody thought about competitors like Rivian and Neo, who are also pretty hot stocks right now.
Yeah. So like I think Rivian is incredibly overvalued. They're gonna produce like 1,000 cars this year. The problem with like manufacturing is scaling, right? But just because you can produce a better car, first of all, their costs can be really high, but let's say they can produce they can produce a better car, like they can't scale it. Like Tesla's been scaling for the last 10 years, right? So they're not gonna get to scale. Also they're super overvalued. Like they're crazy overvalued.
Yeah.
Yeah. So
The issue with a lot of those companies are everyone is hoping to repeat the Tesla performance stock wise. So they're hoping to make it big, but because of that, the price expectations are sky high, and they need to be performing to perfection in order to even justify it.
yeah, like Rivian's valued at what like Rivian's valued on like Tesla's past performance, right? They haven't shown anything. They're actually overvalued than based on Tesla's past performance. So yeah, I would invest in Rivian.
I think we underestimate other parts of Tesla, of how they try to do everything in-house, the whole infrastructure of charging and all that. And before they had the sales, they already started building the charging network. And then in hindsight right now, it's like, but of course the customer experience is so important, that my car, I can charge along the way. All the other brands, they concentrate on technology of the car, which is lagging behind Tesla to begin with. But more than anything, the charging infrastructure is not there. It's part and parcel of it. So if you really think about the execution of Elon Musk, he's just, I think he's just incredible, not in terms of just getting things done, but his comprehensive planning of deploying this. It's not just cars. That's important, but it's just only one part of that. And the only thing that they don't make is actually tires. The charging experience is so vitally important. I just drove down to Santa Barbara, and my screen shows me where the charges are, and I show up, and it's really true, and every freaking one of them works as promised. And just the whole nature of driving the car, which is already superior, but with the charging and all, the whole experience is just like no-brainer. You don't have to worry range anxiety and all that. It's just the execution of this company is just incredible, So that's another reason why I think that is just a fantastic company to invest in.
Mm-hmm.
But do your own diligence, though.
It's really fun to drive.
And maybe I can offer some ideas of what I'm doing. That I think for me, hopefully, the context is more important than the actual instrument that that I'm invested in, and I'll share that at the end. So I'm actually in technical sales. So I'm on the technical side of cybersecurity sales. So I'm very sensitive to what my company's product is in the marketplace and how that's interpreted, right? And how that develops over time. So that's a key aspect of my particular company to invest in. And I think everyone is aware of Kathy Woods, right, of ARK Invest.
Mm-hmm. Oh, incredible.
Yeah, so I think, the last, this year, they've had a really hard time with their portfolio. But I'm not advocating their portfolio, their ETF per se. But I think one thing we can from them is how they use portfolio allocation to generate an additional amount of alpha in their returns in the portfolio itself. So, on sideways markets or sideways performance, they'll generate alpha just by I always say, like, moving the portfolio around. So I'm not advocating that anyone invest in ARK, right? But I think the taking advantage of volatility is a key, I think, a meaningful area to investigate. And lastly, I'll speak to this is, the big thing I learned from options from last year is this very interesting concept of time within options, right? So I think that's a worthy while topic to look into if anyone is interested in it, right? And then lastly, I'll conclude with what my position is from a portfolio perspective, and then what I plan to do this year and what I did last year a little bit as well. So I have I have a pretty large, as a percentage, I'm not going to say dollar amount, it's not a large amount, but as a percentage of portfolio, I hold primarily Tesla. And then I have sold, like I think one of the other guys mentioned it. I've sold naked puts on Tesla as well. There's very interesting. I'm not concerned about the return, but hopefully the big takeaway someone has is really understanding the concept of time with options, right? And then the other thing I did last year was, I did some Tesla call options as well. And then this year I'm doing what they call a synthetic long, which is using options really to sell a put and then buy a correlated call option as well. So I'm holding my core stock position and then using margin to kind of using options to take advantage of volatility a little bit in the market and taking advantage of time to my benefit. So hopefully those three things around, my experience in technology and why I chose Tesla. And then second of all, understanding how volatility can be leveraged. And then thirdly is understanding how options and time can be leveraged to generate alpha as well. So the specific instrument doesn't matter as much, but I think those concepts can help you, further research and add additional alpha to your portfolio without adding actually more risk or not significantly more risk.
Awesome. Thank you for sharing that strategy, Ty.
I'm sorry?
Oh, thank you for sharing your thoughts. All right, we're coming up on the hour. So if anyone wants to share their contact information or any sort of further follow-up, feel free to shoot it down in the comments. I know there's been a lot of back and forth on the comments. I guess the last question is Anthony. What do people think about Chinese stocks? For example, Alibaba, JD, and so on. It's a controversial subject, but has anyone invested or have a perspective on it?
All right, I'll share this, and I'll be very quick.
Sure.
A lot of the tech companies actually are not by government mandate that non-Chinese citizens cannot own these stocks. So what they do is they actually create an entity offshore where that entity sells quote unquote access on the public stock market to that entity. That entity has a right to specific stocks in Chinese companies. Like I think Alibaba is one example. But that quote unquote right could be easily removed, right? So you don't actually own. I don't know about all of the Chinese stocks, but the large ones that are well known, you actually do not have a financial stake. You don't have a right to the stock itself, right? You actually have you're buying in a way an agreement or a warrant that could be at any time removed. So I did own some stocks like 2019, some what's that coffee company? Luckin Company. I actually made money, but that was my first foray into Chinese stocks. And then the other thing I'll say is that in China, it is not illegal for executives to trade ahead of news. Yeah. So anyway, for various reasons, I no longer invest in Chinese stocks. I think there's other risk-adjusted opportunities out there.
Right.
Yeah, I mean, I'll just kind of add to that. I bought several Chinese like Baidu a while back and Alibaba And the problem, these stocks are good for momentum, like whenever there's a lot of news cycles. I mean, I made some money off of them, but some of the other ones, like for example, there was there's a lot of little small Chinese stocks that came on like the last 2 years. Many of these are what I call shell companies. So my problem with them is that there's not a lot of disclosure on the governance for that. So whenever you buy shares of a company, you technically own part of the company, and there's shareholder meetings and there's all these things that you actually have to kind of follow up with. But because the way China does their business, they don't, there's not really transparent. So people buy the stocks just to make money. But in reality, if you're a large shareholder, you don't have a lot of there's not a lot of accounting accountability on that. So if you want to open up their accounting, it's very hard to start to peer through some of their financials, and they'll give them to the SEC. They'll ship them out there, but there's nobody there to verify it. There's this whole documentary called The China Hustle. I don't know if you guys ever seen that documentary, where they would actually spin off companies in China and then sell them to US investors or outsiders, because they basically just wanted to make a quick buck. And when people went to China to actually see the factories, they basically found nothing there. It was literally a sham or a scam. And over there, it's perfectly legal. I mean, it's pretty much, there's not a lot of protection against investors, because over there, the way they look at it is more like kind of like almost like gambling at some point. And so the mentality is a little different. Not to say it's one's better than the other, but the problem is that if you compare it to US standards and also to their governance structure, there's not a lot of transparency. So you could be investing in Alibaba, but you're technically investing through the Cayman Islands. And so they usually have a shell company in the Cayman Islands that actually funnels all their financials through. And then the accounting firms that they hire to audit them are generally paid. So if you actually want to see how much they're making or what they're doing, you actually have to go to Asia and go directly to their office to actually see it, because most of the time, a lot of it's fabricated. And what we saw a lot of was there's a lot of scandals that happen, and Luckin Coffee was a perfect example of something where they were saying that they were better than Starbucks. But if you actually went to their store, you actually physically flew out to China, you saw that there was no way that happened. Most people are not going to do that, right? They're just going to buy the shares of Luckin Coffee, thinking that it was going to become another Starbucks. So I stayed away from Chinese stocks. I think the story at that time was China was going to overtake the US, and it was growing at double-digit rates, and it was going to be unstoppable. It's going to displace the US as far as the top economy. But now we already know that there's a lot of fraud over there. And if you're going to put your hard-earned money in that, you got to be really careful, unless you fly out there directly, meet the actual CEO or company, and see the actual product. Then other than that, you're just kind of almost investing in possibly something really fraudulent. Now, I thought that the SEC had vetted them, because they were listed on the main exchanges. They were listed on the NASDAQ and the NYSE. But what I found out was that they don't really check any of that. Anybody could list as long as you pay. And so what had happened was they were in bed with the accounting firms for Luckin Coffee specifically. And they do that a lot with crypto. Crypto is rife with a lot of scams. And so what I would say is anybody who's investing in Chinese companies is, unless you know directly that contact, I would kind of stay away from them, just because they don't have the same quality control on some of these companies. It's a really sad thing. Same thing with the SPACs. I don't know if you guys invested in any SPACs last year, especially Charmoth. You guys ever heard of him? Charmoth with the IPOE. A lot of those were just like money grabs, but many people felt that Charmoth was a good guy, but he was spinning out SPACs left and right. And what had happened was they were kind of bypassing a lot of the proper ways of vetting these companies. So even in the US, the SPACs were very dangerous for a lot of people. So I'd be very, very mindful of that, especially when something looks too good to be true, like it's going to beat Starbucks. Like it's very difficult to compete with something that's really established. Same thing with a lot of these car companies, EV companies in China. Even though they have the tech, they just don't have the branding, and they don't have the execution. They may have the manufacturing side, but they may not have the global kind of presence that some of the American companies do. So, but
yeah, the past few years have been SPACs have been extremely popular, since they're so much easier to list.
Yeah.
Chinese people are Chinese people. When I say Chinese people, people in like Chinese people in China, right? They're primarily invest their funds in their real estate, right?
Yeah.
As a percentage of I guess of citizen participation in the stock market, Chinese people are the lowest in the world in investing in their own markets.
Yeah.
Interesting.
Yeah.
Yeah.
And yeah, actually, if you ask any Chinese, any Asian, like, I mean, I'm from Chinese descent, but I always ask my older relatives from China, I said, do you invest in stock market? They think it's really risky and they think it's fraudulent. And so when I say, oh, I'm investing in Luckin Coffee, they kind of look at me like, are you crazy? They rather invest in a house because it's tangible. And in the US is the opposite. Even though there's a lot of people investing in real estate, a lot of people think, they kind of trust the stock market to a certain extent. And homes are more for living, but in Asia, it's the opposite. Homes are more like for flipping and investing and making money off of it, not necessarily to live. Now that's a generalist statement. It's not necessarily true for everybody, but some people obviously do that. But I find that a lot, the culture is a little different. So it's expected that you're gonna get fleeced in the stock market, I guess, in the Asian stock market.
Yeah.
So
I think that's the point of how much money one person has. I mean, if you have enough money to buy a house or put a deposit and good income and all that, then you can do real estate easily. But a lot of people have like 10,000 or whatever. You can't even participate in getting a house. So the equity market of buying stocks is actually a viable option because it's an investment, quote unquote. But having said that too, I mean, I had Chinese stocks too, and one of the few things that I can be proud of myself is I actually sold them because China was kind of cracking down. This was like a year ago. So besides the point, I think it's like, why even bother? It's something that you can't really verify easily. We've got great stocks here. I mean, Silicon Valley is just about 20 miles from you. Apple is doing well. World brands are doing well. So I hear that. I hear that a lot of times we want to discover that hidden gem, and therefore we can have like a 20x or something. Yeah, but you can get burnt also. Not that there won't be hidden gems and all that, but we have world-renowned brands with governance, with rule of law, with transparency, audited records, and all that. I mean, I would not even waste my time doing something that I have no chance of auditing, like what Ivan was saying. Having said that, though, Chamath Happy Pelletier or something. That guy. Chamath Pelletier. Yeah, okay. So he's actually a really brilliant guy. I listened to his podcast called All In because he's got 3 card buddies. They're all really, really smart and financially successful and ethical too. I mean, all that you said, I agree with you. But when I listen to him, they talk about a lot of stuff, investments, politics. They talk about science and all that. So I would just encourage anybody who's got a chance to just go listen, because I learned a lot about a lot of things, not just investing, and the whole idea of how the intersection of all these things happening, especially California politics. So if anybody has a chance, give it a try. All In, Chamath Pelletier and his 2 buddies, they're quite good about the virus, about just all that, But anyways, that's my suggestion.
Thanks for the recommendation.
Sure.
All right, we're coming up on 2 hours. I feel like we could go all night, but in the interest of everyone's time, thank you all for joining. We'll have more of these so that we can continue the discussion. We can explore more topics in depth and so on. And going forward, we will also have panel discussions and invite experts to talk about different subjects. So thank you all for joining tonight and staying for 2 hours. This is a great session and really enjoyed it with you all.
Yeah.
Thank you.
Thanks everybody.
Awesome.
Thank you.
Thank you.
Thank you, Sam, for putting this on. This is great.
Thank you for joining us today. If you'd like to stay up to date with us in the future, please subscribe to our YouTube channel, visit our website, and join our Facebook group.